Hi, you guys, and welcome back to the podcast.
We are the Karwells.
I'm Emily.
And I'm Sarah, and we are, as you know, Airbnb interior designers and investors. All right, welcome back, everyone, to the Catch Up with the Karwells podcast. Today, we have Steven as a guest on our podcast. He is a repeat guest on our podcast that we interviewed maybe a year or so ago. But he is a CPA who specializes in short-term rentals. And that is a world that Emily and I are not even going to pretend like we understand intimately in any capacity. So we are always excited to pick his brain. But Steven, thank you for joining us today.
Thanks for having me. I'm stoked to be here.
Well, for our listeners who maybe are unfamiliar with your story and how you got started in this industry, why don't you kind of give them your elevator pitch about who you are and how you landed where you landed?
Yeah, absolutely. So my name is Steven Gabrielsen. I'm a CPA. I've been a CPA for about 8 years. And I am a tax strategist. And so what I do is I basically help people who make a decent living, help them find ways to eliminate their tax liability as much as possible, and while building long-term wealth at the same time. And so naturally, that has fallen into the real estate realm because those two go together so magically well. And yeah, been doing that for the last 4 or 5 years.
Amazing. Well, I tell you what, good for you for being excellent in this industry, because everything about taxes and when it comes to business has been, like, I would say, the largest learning curve that Emily and I have gone through. We are not, or I am not, Emily is, a naturally organized person. So honestly, I think I'm probably your worst nightmare of a client. But we've made strides.
I am a naturally organized
Bring it
person,
on.
but literally everything about taxes, tax strategy, all of it confuses me, scares the crap out of me. I hate looking at numbers in that way, and so I just literally put it off to the last second.
Yeah.
Yeah, that's actually natural. A lot of people always during tax season or during extension season, what we call it, which is what we're going through right now. I mean, we got our final deadline here in about 10 days. And everyone always says, hey, but I got you my stuff like August 30th. Like, why is that not enough time for like the business extension, right? Which is like 15 or 16 days from then. Or for example, it would be like September 30th, they get us their individual stuff. And it's like, well, why is that not enough time? Gave you 3 weeks. It's like, yeah, but what you don't realize is that 100 other people also gave us all their stuff on September 30th. So it's like, that's really the issue is it's totally natural to want to wait till the last minute.
Oh my gosh. I didn't think about the fact, because I know that date's coming up. I already have mine taken care of. Sarah, I don't think does. But I can't believe you squeezed us in, because I can only imagine how busy you are right now.
Yeah, it's a little nuts, but we got a good team. The team's kind of churning along. We've gotten our systems plugged into play this last yeyear. And it gives me the opportunity to be able to step back and answer my phone and answer text messages and jump on fun stuff like this, where my value is really where I'm really valuable in this type of environment. So,
well, we probably could have an entire episode on you teaching us how to remove ourselves from working in the business, because we are so guilty of that. But before we get started, and before we kind of start picking your brain around taxes and your build out that you've done this year, as you know, we start every episode with a horror story. And even though you are not necessarily an Airbnb operator like we are, I'm sure as an entrepreneur you have a horror story to share. So let's start with that before we dive into all the rest of it.
Yes. So I was thinking about this, going through this, and I do have a pretty good one, and this actually came to a head this last tax season, and it's kind of it's one where I want to reiterate the importance of getting advice from someone who knows what they're talking about, and then sticking with that individual to help execute properly. We had a client come to us, actually a group of clients. It was two people. And they were getting ready to set up a partnership to go invest into a lot of properties together. And so the way that we typically set those up is we set up a holding company. That's our main partnership, right? That they both own 50% of. And then that entity then goes and opens up subsidiary LLCs that then own the investment properties that they're purchasing. And it makes it more simple from a tax standpoint because you can roll all the properties up into one partnership and it gets split. And it's really quite simple, right? So we went through the process. I probably spent 4 or 5 hours talking to these guys about setting it up, how to set it up, held their hand through the entire setup process, helped get EIN numbers, all the stuff, right? And then about 6 months later, it comes to do the tax returns, right? We start reaching out to them to get documents and all the things. And they decided to take it and go somewhere else because they didn't want to pay the fee for it, you know? And all of a sudden, about 4 months later, I get an email from this gentleman with an IRS notice wondering what happened. Like, why did we get this notice? What's going on? Didn't we extend these things? And what had happened is the new CPA that was working on the actual, on the partnership returns actually filed each subsidiary return as each individual entity without filing the main holding company as the partnership. And so it kind of blew the entire thing up because now operating agreements don't match. EINs weren't like filed properly. So they have this random holding company that in theory doesn't actually really own anything through tax returns now. And it's just kind of this big old mess that they now get to go through their new CPA and try to sort out and figure out what happened and how to fix it. So that's the horror story that I have. Get good advice and stick with the person that helped you set it up so that you can make sure you execute it properly. And I could go through about 6 or 7 stories like that, but
my gosh.
So that's a
I'm
good one.
Jumping ahead in questions, but I think that it's very interesting that you say that like you were kind of helping them figure out how to structure it, because I think traditionally, if I'm thinking of a CPA, just like my basic knowledge, I don't think of going to figure out like how I'm going to structure everything. But in reality, that makes sense. Like everything's kind of linked when you're talking about tax strategy and things like that. And we have people come to us all the time, like, how do I structure my business? How do I do this? How do I do that? And we're like, I have no idea. And it makes sense that having one person that kind of carries you through the whole process would make a lot of sense. But I think traditionally, I don't know that a lot of people would know to come to somebody like you to do all of that process.
Yeah, and it's not necessarily something that we focus on, right? Because we're not attorneys. As a CPA, I give tax advice. I can't give legal advice. But there's a lot of tax implications when it comes to opening up LLCs in certain ways, right? So we give it from the tax side. We have a team of attorneys that we work with that also does a really good job of building kind of what we help our clients set up. So we give the idea, the nutshell of it, and we kind of build out an overall structure diagram is what we call it. And then we basically team them up with an attorney to help them build it. So the attorney does the asset protection side. We do the tax side. I know enough about asset protection to be dangerous, but yeah, don't take asset protection advice from me. Take tax advice from me, which is the most important piece.
That makes so much sense. I mean, honestly, I would say this year for Emily and I, especially for between my husband and I, because now we've got this, growing portfolio of properties. And it's no longer just 1 or 2 properties, that we were going through the process of asset protection this year. And I had set up all the LLCs myself up until this point. And I put myself as the registered agent on every single LLC because I just didn't know anything about it, right? Just set them up as is.
Right.
And then I reach out to this asset protection attorney and he's like, Sarah, even if we change the registered agent, it's always going to show you as the first registered agent. And so if you truly want these assets protected, now we have to go back through and start all new LLCs, all new bank accounts, so on and so forth. And so now I am in this mess that I caused, that I have to go back through and collapse. It's just my biggest learning curve in this entire thing is I just thought that attorneys and CPAs and everything were somebody that you brought in once your business was big enough, not someone that you brought in day one to have a conversation with and be like, okay, how do I do this correctly?
Yeah, it's important as soon as you start to venture out into anything like that requires LLCs and stuff. There are a lot of people, I do 15-minute consultations for free. I just did one about an hour ago, right? Where I kind of walk someone through the process of how to set the LLC up in general. What are the overall goals, and it's important to get that piece of advice. So you make sure you do it right from the get-go so that when you get 15 LLCs or however many LLCs you have, right, that you don't then have to go dissolve all of them and start over in order to get the proper asset protection. So Yeah, it can be tricky when you're
Yeah,
getting
and
into the
dissolving an
details.
LLC, I did that because I had one in Texas and now I'm in Michigan, and it just didn't make sense to have the one that I had anymore. And so I did that, and I was like, this is like kind of a complicated process. And I did everything through LegalZoom, but when you're starting maybe 15 LLCs, it doesn't make sense to do it through LegalZoom because it's like $500 a year for like
Yeah.
fees, and then you're paying all of this extra stuff, and it doesn't make sense to do that. So having like a team of people who are like, nope, this is how you do it, these are the steps, and it gets really simple once you know what the steps are, but you have to know those first.
Exactly. That's exactly right. It's there's always that pain up front with learning how the foundation should be set up. But if you set that foundation up correctly, um, and you learn kind of how to do it along with the professionals that are helping you, then you can basically take that as your springboard. And then at that point you can go inkfile.com and set up a future LLC, and you know what entity is supposed to own it and how the LLC is supposed to be set up and how the EIN is supposed to be filed. And so then at that point, you can kind of start doing a little bit of these things on your own. But it's important to understand the foundation and as far as like what the long-term goal is and why you're
Yeah,
setting it up
and
in the
can
way
you
that
kind
you
of
are.
explain, because when I think of like the CPA that I had growing up, when I was like, I got my first job at like 16, I think, and it was just an after school job, things like that. It was literally just, I have all these documents I put together, I send it to this lady who I literally never see, I never even meet with her, and then she sends me back, this is how much you owe, or this is how much you're getting back. But you do so much more than that with your tax
Yeah.
strategy and things like that. So can you kind of explain like what a tax strategist, like what your goals are with your clients and kind of what you're setting up with them?
Yeah, that's a great question. So, really, when you're working with someone like us, who's more on the tax strategy side, the tax return itself is a byproduct of everything else that we've done throughout the year, right? So, what we do is we focus on sitting down with our clients every single quarter, and talking with them about their specific situation. If we're doing bookkeeping for them, we sit down, we pull up their financials, and we do an estimate for what we think they're going to earn between now and the end of the year, right? And then we talk to them about the different investments that they can get into, whether that's real estate or oil and gas, or if they're reinvesting back into their small business. Whatever those investments are, how can they make those investments in a way where it's going to reduce or limit their tax exposure as much as possible, right? Same thing goes with if they're going out and buying new properties or new short-term rentals and stuff like that. What LLCs are they buying, and then how do we have to structure the LLC? When do we need to get the LLC set up? And then who else do we need to talk to in order to make sure that we go through that process correctly? So when we come down to tax time, it's outside of like the first year of working with someone, year 2, 3, and 4, it should be a very streamlined, systemized process because bookkeeping set up, our conversations as far as what your strategy looks like is already set up. And so the tax preparation portion itself should be very simple. But that's really the biggest change is it's developing that relationship throughout the year to where we have a very clear understanding of what your long-term goals are. And then we're here to help you execute those long-term goals to make sure that everything else just kind of falls into place as we go along.
That makes so much sense. Well, and it's one of those things where like, even from when we were just starting our business out, like we didn't even understand necessarily how money had to flow through certain things for it to make sense from a tax perspective. So I was having a conversation with one of the investors on one of our properties a couple of weeks ago. We went and visited them in Washington, and I was talking with him about how all of his money flows through different bank accounts. And my one question that I had specifically when I was like, okay, I need to ask Steven this when we bring him on the podcast is, let's say like we have one credit card, right? And we open up a new property and we put all of the furniture on that one credit card, but the credit card is in our personal name. And then we pay that credit card off with our personal income. Is it enough to just have the receipts saved from all the purchases that you made? Or does it need to does that income need to come out of that business bank account that is associated with that LLC? Like how clean do these books have to be from a transaction standpoint for it to, like, if we were to get audited, all of a sudden we're not like up shit's creek?
Yeah. Great question. So at the end of the day, the IRS mostly cares about your intent. What is your intent with those purchases, right? So if you buy it out of your personal bank account and it's a couch, for example, but it's very easy to go look at that couch and it's in an Airbnb property, and it's very clear that that couch is used 100% for that Airbnb, right? It's very easy to then justify the cost of that being within that business account, or with being on that form within the tax return, right? The main issue with commingling funds, which is in theory what you're doing, right? You're using your personal bank account to then go buy business assets. When you commingle funds like that, what you're actually running into is you're running into a lot of asset protection issues. If that LLC that owns that property gets sued and they go in and try to figure out what's going on, and you've used your personal account for all of those purchases within that Airbnb property, they can do what's called pierce the corporate veil, or basically say that LLC doesn't exist from an asset protection standpoint because you're not treating it as a separate entity. And that's where the biggest risk comes into play when you're commingling assets like that. From the tax return, it makes it really messy. So it's really difficult for someone like us to sit down and say, okay, we've got our LLC bank account, but the client's claiming that they spent 50 grand on furniture and all these other things, but we don't see any of that in the business bank account. Where the heck did you buy all this from? And then you have to go comb through your individual account to then get us a true number of how much you actually spent for furniture, right? That's where the issue comes from a tax preparation side. It's just a little bit more messy, a little bit harder to make sure that we get the most accurate information possible. Whereas if you run it all through the business bank account, it's very easy to go sit down, reconcile the bank account. This is all furniture. This is all equipment. This is all repairs. This was all yada, 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 right? It's very easy to break that out in a business bank account when it's all separate. But as far as like the main issues that arise from using a personal bank account, you're really looking at an asset protection issue if you were to get sued.
That makes a lot of sense. And yeah,
good question,
I ran into the same thing where like I started the LLC in the bank account because I lived in the property for a year. It was my personal home, but I was renovating it and doing all the things into it. And so I started the LLC and got the business bank account ready and the business credit card a couple months before I actually listed the property. So everything else was on one credit card. Like I tried to keep it as organized as possible, but that still is a little complicated. But and then I was kicking myself in the butt because you get that business credit card and they're like, oh, if you spend this much, you get this much back. And I'm like, I spent that 2 weeks ago. So that's great.
Yeah, right. That's funny. And like, that's a great point though, because a lot of people will go into an Airbnb property, live in it personally for a little bit, and then flip it to an investment property. And from that standpoint, if you're living in it personally and you're using your personal funds to buy stuff for that property, you're going to be fine because you were using it for personal usage in that time, right? Where the issue comes is as soon as you start to flip that to a business activity, that's really where you want to start treating it separately and get all the activity flowing through that business bank account. And then you're going to be able to avoid a lot of those issues. So that's a great point.
We've done that on almost every single property. And so I think that's why it ends up a little bit messier than normal. But this year, at the beginning of this year, I guess the end of last year, we hired a bookkeeper and she has been a godsend. An absolute godsend.
Oh, that's amazing.
I'm like, well, this is the one person I should have hired literally day one out the gate.
Yeah. See, that's amazing. Cause like from that horror story that I talked about at the beginning, right? On the flip side of the coin, we have another client that we work with who has, they came to us with already mostly a built out team, right? Their bookkeeping was an issue. It took us about 6 months to clean it all up just because it was kind of a disaster on that point. But they're so dialed in. I think they've got to have 200 or 300 doors. They have a lot of properties in all their portfolios, right? And they're to a point where they go buy a property, the attorney sets up the LLC, gets the EIN number, gets the operating agreements, gets it all dialed in. The attorney just sends it straight to us. We can then go in and plug it in on a tax return. The client doesn't even really have to do anything for it. The attorney then goes and sets the bank account up, gives the client the credit card to use in order to actually operate the property correctly. So you really can systemize the process once you get to a point where you can afford to pay all the professional fees to help run and operate it. There are people out there that do this for a living and help you run these portfolios so that you can buy 5 properties a month and not even have an issue with worrying about setting all these things up and making sure you're doing it right. So there are people that you can put in place to help you run this puppy in the cleanest, squeakiest way possible.
We're getting there. Yeah. Okay, so this is kind of a sidetrack question when it comes to the ideal team for real estate professionals like ourselves to have on the back end once we can afford all of those things. Is it just one CPA and one lawyer or attorney? Because right now, the brick wall that I've hit that I think I might have just figured out slightly is we use Jeff Hampton, full transparency, on the asset protection side of things, but he does not handle whatsoever deal structure, right? It's a whole separate team because he's only focused on asset protection. He's not focused on any sort of like fund, syndication, partnership, JV, anything along those lines. So for real estate professionals, what does that ideal team look like when it comes to kind of the backside of your business?
Yeah, great question. So again, it depends on the end goal, right? If you're going out buying single properties and stuff like that, and you're just building an overall portfolio, then you can kind of go with a more simple, a more simple model where you're working with someone who's more on the asset protection side, and you just reach out to them and say, "Hey, we're under contract with this property. Can you help get the entity set up?" And they'll get it set up for you, right? Where on the flip side, if you're doing more syndications, trying to get investors and trying to set up deals and stuff like that, it does take a more of an established group of attorneys to help with that. And a lot of bigger attorney groups, they have areas in their firms where they cover multiple things, right? They have asset protection group. They have people to help you with the deals. They have people that will help you with all sorts of things, right? So that might be a point where you're getting to the point where you're outgrowing that attorney, and you need to start looking for someone that has more help inside their company that can help you with those individual pieces. So a lot of it comes down to what the end goal is. If you're going to the extent of getting investors and getting and building out more of a syndication style business, you're going to need a more robust CPA that can help with a lot of other factors, along with an attorney that can help out with a lot of other factors, along with a good management team, along with a whole team that help you actually run the actual business itself, right? Where when you're working on just going property to property and building a portfolio out in that standpoint, obviously you make sure you have a good property management company that you work with, maybe a manager too that helps you actually go find the properties and put them into place and stuff like that. But your team's a lot smaller in that situation. So it kind of depends on the overall end goal for what you're trying to build. Just to determine how robust
is
of a team
it
you
normal
need, right?
for, and now I'm asking you lawyer questions as the CPA, but is it normal to have two separate attorney companies handle asset protection and deal structure, or does it make more sense, like for you as the CPA kind of plugging into the equation, for it to be one team that handles both?
Yeah, that's a great question. So I wouldn't say it's not normal, if that makes sense. It's not abnormal. Attorneys are a lot like CPAs, right? You have CPAs that just do audit. You have CPAs that do private corporate accounting, right? There are CPAs that do different things. Just because you're a CPA doesn't mean you're a tax professional. Attorneys are the same way, right? You have attorneys that specialize in lawsuits and litigation and asset protection and all sorts of different things, right? And so it's not uncommon to have an asset protection attorney if they're just in the asset protection world, and then have another one that can help with your actual deals and making sure that you're setting and structuring the actual deals and stuff properly, right? So it's very normal to have a group of attorneys that work together. You just want to make sure that they're all connected, right? You want to make sure the asset protection attorney is connected with the one helping with the deals, and both of them are connected with your CPA, so that you can make sure the whole ecosystem is under the same understanding as far as what's happening, so that everyone's on the same page. That's probably the most important thing, is making those connections between the professionals, so that the attorney going and helping you with the deals isn't setting up or giving you advice on setting up different entities that the asset protection attorney says is just going to blow up your asset protection structure, right? Whereas the asset protection attorney isn't going up and setting up all these entities that are going to blow up your whole tax situation. So that's probably the most important piece, is just making sure that everyone's on the same page when it comes to the professionals that you're working with.
Okay, that makes so much sense. So then, this is probably a question that, well, we'll see. We'll see if it's something that you want to answer or you don't want to answer. But are there situations where you get introduced to somebody's attorney of sorts, and you're like, just because you deal with attorneys so often and you deal with deal structure so often, will you go to a client and be like, you need a new attorney? Like, this is not a good fit for your business?
I'm very black and white. I am very black and white. If I think the guy's a dumbass, I'm going to go tell him that he's a dumbass and doesn't know what he's doing. I take that very seriously. And in my opinion, if you have an attorney that's sitting there saying and claiming to be an asset protection attorney, they better know more about asset protection than I do. And that's it. Going back to the horror story, the attorney that, those guys that even went and talked to an attorney about stuff. And it was an attorney that helped with deal flow. It was a real estate transaction attorney. She came to me and was asking why it would even make sense to open up a Wyoming LLC. And it's like, that's such a, it's such a simple question that any attorney that's saying that they should be an asset protection attorney should know the answer to that question. You shouldn't be reaching out to a CPA asking that question, right? And so it's just making sure that you stay in your lane, right? And it's the most frustrating thing to me is when someone tries to get out of their lane and give advice and try to help. And try to help is probably a bad way to say it, because that's probably them being nice, but try to give advice on something that you don't know much about, it drives me insane. And so I am very black and white with people, and I'll tell them to get a different attorney or get a second opinion. I usually try to say it in a very nice way, I try not to be too rough around the edges, but I softly nudge them to getting a second opinion.
I'm so glad you asked that question, because I was going to ask that, and I was like, I don't know if he's going to want to answer that either, because it seems like you have connections, right? Like you have a team of attorneys that you traditionally work with. And so I'm guessing that if somebody doesn't have that option, you're usually recommending the group of people that you work with, because you already know how that process works. And so if somebody's plugging in somebody that you're not used to working with, and they just kind of come off as like not understanding, it's probably really frustrating, because you're like, I know people who do this right.
Yeah, exactly. And I'm not opposed to working with new attorneys, right? I'm always looking for new attorneys that I can give more referrals to, because it's like, I think we have 3 that we currently give referrals to. But it's not 100% guaranteed that they're going to jive with the people that we send them to, like there are different personalities out there that work better with different people. And so having as many referrals as possible, or referral people that I can refer people to, for the asset protection piece it's important. And, so I am always open to working with new attorneys that really truly understand the asset protection side. So if someone is an attorney listening to this, reach out to me. I'd love to send people to you. So always looking for good attorneys that's
amazing. That's reassuring to me too, because it's like, from our perspective, all of this is very new, very intimidating for us. And so having people in our back pocket that are going to check us, right? Like I love the idea of it being all in one house where you get to meet the person that I am dealing with, and try and coordinate with them, because there's going to, like, for me to try and translate all of that information accurately to you, like I haven't even tried yet, and I already know I'm going to screw it up. Right. So I need people who are like checking all of my bases as well. So that makes so much sense to me. Go ahead.
Yeah. And I mean, even as you do it, like when you're trying to open that line of communication between the professionals, get on calls where everybody's on the call. Like a call like this, where all 3 of you sit down, your attorney, your CPA, and you sit down. Because usually when we sit down in that type of environment, it's hard for an attorney, if they don't know what they're doing in that situation, it's hard for them to even try to walk the walk, right? It's hard for them to even keep up with the conversation if you're going through it and everyone's on the same page. So it becomes very clear, even from the client's perspective, to understand that that's probably not the best fit from an attorney standpoint, or even vice versa. If an attorney's going through all these different LLC structures and the CPA sitting there saying, like, kind of questioning how it's going to affect the tax situation, it becomes very clear the CPA probably doesn't know what they're talking about, So sit down with them all, not one-on-one, but in a group setting, and then go through the structure, go through what your long-term goal is and how you want this thing to play out for you in the next 5 to 10 years, and let them help you build it together. And it's really the best way to kind of vet everybody at once.
Go ahead.
Well, I was going to switch gears a little bit with my question. So if you have another question in this direction.
I was going to switch gears as well. So you go ahead and I'll ask my question.
Well, without giving away too many secrets, because obviously people are going to get the most value from like actually having a meeting with you and sitting down and talking about their specific business. Well, what do you think short-term rental hosts, like when you have meetings with people, what's the biggest aha moment that they're like, oh, I would have completely missed that if I was going to somebody who didn't specialize in short-term rentals or something like that?
Yeah. So that's a great question. And the biggest difference is it comes down to whether or not they actually own the properties or not, right? Because if you have an STR host and they just kind of host it for other people, that's a different situation as to whether or not they own their own properties and then host them, right? The biggest revelation that people usually have when we sit down with somebody is the fact that they shouldn't be paying tax on majority of the income that they're generating if they're continuously buying more and more property every single year, right? Someone who buys 2 or 3 STRs a year and is operating them themselves and is building a business around it, you shouldn't be paying much tax, right? Because you should be doing cost segregation studies on those properties, accelerating the depreciation, using those benefits that come in real estate when it comes to the tax side to offset a lot of that income, if not all of that income, right? So that you don't pay any tax. Now, on the flip side of the coin, if you're just a host and you're hosting Airbnbs for other people, that's a little bit different, right? Because you don't actually get to depreciate the properties because you don't own the properties. So at that point, you are actually running an actual business where you have to find other expenses and other ways to invest either back into your business or invest in your own properties so that you can get those deductions, those benefits. But the main light bulb moment that people really see when they start sitting down and working with us is the fact that they have control over their tax situation, right? Like if they don't want to pay tax, all they have to do is go invest in their own properties, right? Or if they're okay with paying a little bit of tax, how do we invest the money back into the business so we can grow the business to limit the tax as much as possible? But just having people understand that they kind of have the control to make the decisions as far as what's going to be reflected on the tax return is a pretty big moment for most people.
I think that's going to be, for our listeners, I have a meeting with Steven tomorrow around our taxes. So that's why there's going to be a lot of overlap in our situation specifically. But for Emily and I, this year, we've obviously got the real estate portfolios aside that we are always continuing to reinvest into. But now we've got this social media brand that is bringing in a good chunk of money that we are kind of funneling into self-funded real estate, pieces. And so beyond that, we still want to continue reinvesting in the brand itself. And so I think that's going to be a portion for us to understand. Does it make more sense to funnel a lot of our money into the assets, or does it make more sense to, fund it into building out the brand, and what do those tax benefits look like? And so one specific question I have in the social media side of things is this year, Emily and I have launched this mentorship, right? And we are now teaching other people how to invest in real estate to create generational wealth, avoid taxes, all the things themselves. And so at the end of this graduation, at the end of the mentorship, we host a big graduation where we invite everybody out. We upsell them potentially into something else if they want to continue receiving education from us. But that graduation event is a pretty penny. I think we spent upwards of $35,000 on the last one that we hosted. And is that completely tax deductible? Because we've asked one CPA before and he was like, I don't know if you're going to be able to write this off. And I was like, what do you mean? This is literally reinvented.
Did he give you a reason? Did he give you a reason as to why you wouldn't be able to? Please don't tell me he said it was entertainment.
We would have a separate conversation, and we never did.
Wow. So I would 100% you should write that sucker off. I mean, the thing is it's advertising, right? You are setting up this graduation as part of the program. It's very, very clear. I mean, that's like the main two reasons that someone would say you can't write it off is it's entertainment, and entertainment is, so meals and entertainment used to be deductible, right? Trump changed it. Now it was just meals. Or gifts. Gifts for clients are limited to $25 per client. A graduation is neither of those. The graduation is there to upsell them on new products or to make their experience in your networking group an amazing experience, right? It's very clear that is an advertising expenditure, right? So that should 100% be written off. I can't imagine why anyone would say, well, be careful. That's just night and day. 100% write that sucker off, unless there's something blaring into that is kind of maybe shouldn't be. But once we get into the details, we'll be able to kind of go through it a little bit more. But it's hard for me to kind of picture a situation where you wouldn't be able to do that.
I want to keep, one of those things where I think for us in all things, we take our mindset of hospitality in our Airbnbs themselves, and we kind of carry that into our mentorship, and we want to offer this very, one of a kind experience for our mentees, with hopes that they will stay in our community and, continue working with us and continue expanding the network. But at the end of the day, I want to make sure that those things are not coming out of pocket. And then all of a sudden I'm burying myself in a tax bill.
Awesome. Well, the thing is that at the end of the day, it all comes down to whether or not it's an ordinary and necessary expense for the business, right? Now, is it an ordinary expense? Maybe, maybe not. There might be some gray area there, but it seems to me like it is necessary, right? Because you want them to stay in the network, you want them to have that good fuzzy feeling when they hang out with you guys, and you want them to stay long term. And so, throwing a lot of money into a big event like that is very clearly going to that as the end goal, right? So I can't imagine it's not. It's like saying these big companies like QuickBooks and all these people that do these massive events, like what is the QuickBooks one? QuickBooks Live or whatever it's called. They host an annual thing where everyone comes. It's like saying they can't write the expenses off for that. Like it's the same situation, and that's absolutely mind blowing why someone would say you can't write
I
those
always
expenses
think
off.
about that too, because a lot of companies like have big Christmas parties at the end of the year, right? And I'm like, they're doing that sure to like help. They like are trying to give their employees a good experience at the end of the year, but come on, they're not just doing that to do that.
Yeah. I mean, again, the only thing that I can think of would be like the entertainment portion. But the entertainment portion, the reason they split that out is because it was like people trying to take clients to professional athlete games, right? Like NBA games, NFL games, and then they would take their kids as clients or their spouses as clients to these, and then write them off. Like that situation makes a little bit more sense to me. But when you're doing something where it's like a full blown event where you're bringing people together and you're putting on this awesome show for them and you're having a good time with them and you want them to come back, like that's very clearly an ordinary and necessary expense to help build your business. So I would
think the second question I have that seems to be a gray area for Emily and I is, our social media now has become an outreach for people who are interested in short-term rentals and learning about the ups and downs, good, bad, ugly, all the things around it. And so whenever we travel now, we stay in B&Bs, whether we're traveling leisurely or not. When we are in these B&Bs, we use the B&B that we're staying at as a learning tool for our community, right? So I always make a video every single time I go into these B&Bs where we're not getting paid to make these videos. The hosts have no idea they're being made, but I will go through and I'll say, like, these are 3 things they're doing right. These are the 3 things that they're not doing right. Does that qualify for me to write off the B&B expense, or is that just like, no, that's too much of a gray area, we can't write something like that off?
It's a great question. And in my opinion, so before I answer that question, I want to talk about the gray area thing. In my opinion, there's no such thing as gray area. You either can or can't, right? The tax code is written in a way where there's an answer to pretty much everything, right? And you either understand what's going on or you don't understand what you're going on. So if you have a CPA that has if you do it from a level 1 to 10 as far as an understanding goes, if you have a CPA that has a level 4 understanding of these types of transactions, and then you're asking a question that's probably needs an 8 level understanding, that 4 to 8, that's the gray area, because that CPA doesn't understand that area, right? So like there's very, very, very few situations and circumstances where there's quote unquote gray area, right? And now what you just talked about as far as being able to write off your travel to these different Airbnbs and stuff like that. Tom Wheelwright has a great saying that he says, it's not can you write this off, but it's how can I write this off, right? And so pretty much any expense in your life as a business owner, you can run through that question. It's not can I, but how can I, right? And you hit the nail right on the head as far as going through and explaining what you're doing within those Airbnbs. It's very clear that your entire business, social media, your mastermind groups, your portfolio, yourself that you guys run and operate, all of it is short-term rentals, right? How to optimize a short-term rental, how to get profit from a short-term rental, how to make it attractive for people to come and stay in those short-term rentals. So it's a very natural occurrence for you to go stay in other people's short-term rentals to see what they're doing, how they're doing it, what they're doing wrong, what they're doing right. And then using that as a learning tool to then go take it back and apply it to your guys' situation. So yes, absolutely. That travel, those stays, your time there, the meals that you have while you're there, that should all be included as a business expense. Yeah. And that's another great thing about being a quote unquote influencer, right? A lot of influencers fall into that same situation where when they travel, they document their entire travel, right? And that's how they build their business, how you build a following. It's how you live. And so those expenses to go and do those things should be deducted from that income, because that's how you build your business. So it's a very ordinary and necessary expenditure.
That's so music to my ears, because that's what I was telling my husband. We were on our walk yesterday, and I was like, I just don't understand how all of this lifestyle that we've like immersed ourselves into this last year is not a business expense, because that's all we like. Every single move we make has some sort of tie back to our business. And so I'm like, it's not like we're taking time off.
Yep.
Like all of this is for a larger goal. So I don't know why we wouldn't be able to write all of this off.
Yeah, you absolutely should. Absolutely
Good.
should.
Well,
be
that
able
means
to.
that I've got a little bit of work to do on the back end tonight to understand what's been on my credit card that isn't tied to an LLC currently.
There you go.
I do have one more question before we wrap up here. And this has been kind of a looming question that the CPA that we're using right now has not guided us through at all. And I think we might need to make a change before the end of the year here. When does it make sense to switch what we're doing from just an LLC? Like, for example, Emily and I have the Karwells LLC, from just a regular LLC to an S Corp. Like, is that something that we need to be doing now, later? Like, when does that need to happen?
Amazing question. So most of the time what it comes down to is it comes down to the net income within the business, right? There are obviously, there's a cost benefit to switching over to an S corporation. Most people will say that cost benefit or that line in the sand is around $50,000 to $60,000 in net income, right? And actually, Nick the CPA, I don't know if you guys know Nick the CPA, but he did a great video on this actually today. Well, at least I saw it today, where he explained the difference between being an S corp or being a Schedule C business owner, right? When you make that transition, usually, in my opinion, I would say if you have a net income of $60,000 or more, I would say make the conversion to an S corporation. But you need to have that personal touch so that you can understand the long-term goals around it, right? Someone in your guys' situation, just being very transparent with this, what I would do in that situation is keep Karwells as a partnership and open up an S corporation for each one of you, right? So then you each have your own S corporation that the partnership then bleeds up into. And the reason for that is we get the flexibility of the partnership, right? Let's say Emily wants to go take a year off next year and Sarah's going to run the business for a year, right? When you have an S corporation, if Sarah pulls $50,000 of distributions out of the S corporation, Emily's going to also have to pull $50,000 out of the business as a distribution that year. And maybe that's not fair depending on your situation, right? So if we keep it as a partnership and Sarah runs the business for a year and Emily takes a year off, she takes $50,000 out. Emily doesn't have to take $50,000 out, right? So you got a lot more flexibility from a partnership standpoint. And I am guessing, as you two being very entrepreneurial spirited, I'm guessing there are going to be other side businesses and other things that you guys each get individual opportunity to go start, right? And so by having your own S corporations, you're able to do subsidiaries underneath that for the different opportunities that may come into play and not have to have 50 different S corporations that you're trying to manage and run, right? So by keeping Karwell as a partnership, you're able to keep the flexibility and then also able to do your own thing on the side and then roll it up into the S corporation. And the same thing goes, right? If Sarah's doing a lot of travel and going to all these different Airbnbs and Emily is staying in one spot, Sarah can write those expenses off on her S corporation, whereas Emily doesn't then have to eat 50% of those expenses because you want to run it through Karwells. Right. So it just gives you much more flexibility.
That makes so much sense. We had this conversation with Ethan and Ethan's business partner and their CPA, and their CPA was suggesting that like it doesn't make sense to start an S corp because of that exact reason. But he was talking specifically for their partnership, and he never suggested that each of them need individual, right? And so like, okay, well, if Ethan wants to take $50K and Kenny doesn't, like now all of a sudden it doesn't make sense. Thank you. Immediate value.
Yeah. That makes so much sense. Yeah,
because there you go.
You hit the nail on the head. Sarah does do a lot more traveling than I do. And then when we do the business travel together, usually it's Karwells that's paying for that. But like when Sarah's going on her own trips, she pays for those. When I go on my trips, I pay for those. But it makes sense that they would be under the individual ones. Yeah. And yeah, I mean, there is future businesses down the road that we already talk about wanting to do. And so it makes sense to just have all of that, and nobody's ever explained it in that way.
It's just so much more clean. It's so much more clean because when you have something like the Karwells, I mean, you're going to have a million different business opportunities that arise from that, And so the more that you can separate it now, everyone always thinks, oh, I don't want to separate it because we're best friends and we're going to be best friends forever. Like the cleaner that you can make it, and what Sarah's is Sarah's, what Emily's is Emily's, and you separate it out very black and white, it just makes it so much easier down the road, because it's already decided on what goes where and how it happens. And you just got to be organized around that fashion. So whenever we're dealing with partnerships, like someone in your guys' situation, I always recommend each one of you have your own S corporation, have a subsidiary or partnership. And then it's just so much easier to grow it long term.
Well, sounds like we need S corps.
Yeah.
Well, Steven, thank you so much. Where, for our listeners, if they didn't hear the first episode that we recorded with you and they are listening to this and they're saying, holy cow, this is a guy that we need in our corner as well, where can they find you?
Yeah, thanks. So I am Snapback CPA. I always have a hat on, so that's why I call myself Snapback CPA. On social media, we have a newsletter that you can sign up to, that we shoot out weekly newsletters. You can also reach out via our website. Our website is creative-advising.com. And heck, if you want, you can just reach out to me via email. My email is Steven, Steven, @creative-advising.com as well. My passion in life is helping people understand the tax code. So that's really where I'm my happiest and what I love to do. So even if you have general questions, don't hesitate to reach out. Let me know. I'm always here to help.
I love that your branding is the Snapback CPA, because we're known as like the hat girls, because most of the time we're wearing hats. I just don't have one on today. So it works very well that we work together.
Dude, it's meant to be,
Well, we appreciate you so much. For our listeners, as always, all of his stuff, his website, his handle, everything will be tagged below, whether you're listening or you're viewing. So go check him out. And Steven, thank you again. To our listeners, thank you for listening to another episode, and we will catch you next time.